Welcome to the podcast of Data and Analytics in Business. We will learn from the leading industry experts using data and analytics to solve the problems and create values in practice. We will also learn where the industry is heading to and how data and analytics will shape the industry in the future. Most importantly, how they are preparing their business for digital transformation and disruption in the future. I'm your host, Jason Tan, and thank you for listening.
Good morning, Michael. Welcome to the Analytics Show podcast. So excited to have you here today. How are you?
Nice to be here.
That's good. Thank you for your time. And now I'm going to start a little bit of the article that I read that you wrote for Investment Magazine. So the topic is human trust under threat with rise of AI. So you wrote about the issues with AI written news article and deepfake. I certainly know about some of those too. I actually have used the the AI generation for copywriting before. It's bloody amazing. But anyway, talk about, has your opinion changed on the matter since then?
Yes, thanks, Jason. So that article was written just pre-COVID, and I think it was an article really talking about, as you said, deepfakes and this idea of what is real when you have algorithms that can emulate information credibly. So they can write an article for you, it can create a piece of media for you, etc. And if you don't have any certification or if you don't have any way to validate it, then you kind of take it on board. And so this idea that the threat here is that you start to mistrust, you don't know what's real, it's coming at you from the medium. And that automation, as well as emulating these human-like activities, also needs to provide some degree of certainty or certification or truthfulness to them. And maybe that's not there. But I think what it really made me think about, which I think has only become a bigger issue, is as our lives move more and more online, this idea of trust, or at least understanding what algorithms are trying to do and why they're trying to do it, I think becomes even more. And so whether you're thinking about as an individual, so kind of your newsfeed, and you're thinking about, is this real or not real? Whether you're a customer and you're thinking, why was I denied for my credit loan? Okay, some algorithm put me into a certain position or not. We were just talking about junk mail filters. It could be as simple as that. Like, what is the rule for junk mail filters? I don't know. Maybe I went in the wrong direction. Or companies, right? Companies that are trying to deploy algorithms at scale in order to create efficiencies, save costs, and they need to know how those algorithms are functioning, how they're working, what they're doing, why they're doing it.
I think for my view though, is that one of the things that we have to factor in is the human element behind the algorithm. That is a bit that we can control. But at the same time, do you think we should shift more focus on the human? Because ultimately, it's the human who is creating those algorithms. Ultimately, it's the human equally who is training all of those models. How much do you think we should also look at the human factor of that, as opposed to the algorithm or all of these tools then?
So I think it's a very good question, and it's one that we struggle a lot with in finance, in asset management, and fields like that. So maybe I can reframe it for a second. There's two ideologies here. One ideology says that an algorithm is a manifestation of your expertise or of your will as a coder. So whatever the algorithm is doing at scale with lots of data, you should be able to represent it and talk about it as if you were doing it. So if you had infinite time and resources, you would be doing the same things that the algorithm is doing, more or less. And so therefore, it's explainable, it's a manifestation of your will and your outcome, and it's great. And of course, once you start looking into details, you start thinking, well, what about all the bad things that we do as human beings? What about all the behavioral biases and all the negative things that we carry? Does that mean we also carry these into that? And aren't we just doing confirmation bias? So for example, if we were to use algorithms to solve problems that we don't have a very good idea about how to solve, are we just not scaling a bad solution? into lots and lots of places all the time. And yeah, it's explainable. Yes, it's human. Yes, it's a programmer's or an expert's view, but it's fallible, and maybe it's not very accurate, and maybe it's not very good. On the other side, you've got the other ideology that says we can use algorithms to solve problems in ways that humans could not solve them. So we can actually use data. If you think about Go as a strategy, or you think about CNN, or you think about all these weather pattern forecasting, complex systems increasingly with machine learning and with reinforcement learning type models, you're finding solutions to problems in high dimensional space that human beings are not able to process or even understand from a sense of intuition. And so you're kind of at this uncomfortable juncture where that form of intelligence, it's not just about the speed of calculation, it's not just about the volume of data, but the functional forms, the nonlinearity, the high dimensionality of the problem means that you and I are not good at solving those kinds of problems, but an algorithm is. And should an algorithm be forced to explain itself to us or to reduce itself in a way that is human and linear and so on, does that mean we remove some of the explainability of that algorithm? We kind of reduce it in some sense to simple storylines, right? And I think these two ideologies are very interesting, because one says for certain class of problems, we want human intuition, human in the loop, we want transparency, and we don't mind if we confirm our own bias because we like what we're doing and we think we're very good at it, so that's fine. So algorithm is replicating our intelligence, it's replicating our intuition, it's just doing it at scale. So the job of a data science team or a business there is to take a great idea that everyone's really happy with, not even test it or test it a little bit, but essentially to scale it out. It's intelligent automation, if you think about it. On the other side, you've got this idea that we don't know the solution to certain kinds of problems very well. We don't have an intuition, or we're very poor at it. Forecasting is a classic example. People are terrible forecasters for lots of reasons. There's a mountain of evidence and behavioral biases behind that. And so therefore, when we look to machine learning algorithms, we like nonlinearity, we like obfuscation, we like higher dimensional weirdnesses, so long as we believe they're not noise or artifacts of the data, so long as we believe actually the system is pretty stable, it's just finding patterns that you and I cannot follow for whatever reason, then I feel like for those class of problems, we should embrace the nonlinear complexity and see what high dimensionality can buy us. But I think the weaknesses of that, the machine element of that idea, is our ability to tell whether it's noise, our ability to be context free in that assessment. So I'll give you a very quick example, and then
yes, please.
Yeah, very jump. But imagine that we were creating a model for forecasting stock prices, markets, industries, commodity prices, oil prices. Let's go oil price. And we took history and we threw a machine learning model at it. We found certain kinds of relationships between other commodities, trading patterns, geopolitical risk, news, all these wonderful ideas. And the model was great. And it was able to detect that news patterns in the UAE and the US were actually the best ways of forecasting commodity prices. And we learned something that we didn't know as human beings. Mm-hmm. In order for us to test whether we just did an amazing job at data fitting, not data fitting in a data science way, but data fitting in an econometric way, which is a bad thing, right? Where you kind of, you fit your hypothesis to the model. You fit your hypothesis to the data. So you kind of come up with a hypothesis that suits the data rather than the other way around, or testing your hypothesis. You basically are relying upon one version of history, of human history, that has brought us to this point, which had the Suez crisis, which had a number of events in history where the oil prices moved significantly, and you fitted a relationship structure around that. So you can't with confidence say that oil prices in any universe or in any human universe, any human future would be driven by these two things. You can only say with confidence that in this version of the truth, or in this version of history, it has been the case. So when you try to apply that going forward, you have this problem that you don't know which future path that we're going to take, and the dependencies around that matter. So this is one of the classic problems of backtesting or any kind of future forecasting, is that history has limited influence for you because of the idea you only have one history. In the same kind of way, That's why time series forecasting has really not been at the center of a lot of the data science work. It's been primarily around for reinforcement learning has been games, so controlled environments where you can create every permutation of every action and reaction. You don't have to rely upon a single history. And then I think increasingly in the CNN world and in the other stuff, it's been about cross-sectional identification. So not time series forecasting, but is this a fox or is this a bear or is this something else? So labeling essentially, which doesn't require you to understand the context of motion or flow or change, but just about association. And so I think there's this is a really good question where there's certain classes of problems that we might release the nonlinear nature of machine learning onto, and we're confident that it can do it. There's other class of problems where it's not very good and we're not very good either. So we should probably leave those alone, aka forecasting, time series, that kind of stuff. And then there's another class of problems where we're very confident about our solution. We just want the data science team to replicate the intuition of an expert and scale it out across the organization and create consistency and other types of beneficiary effects across an organization, removing some of the other human noise actually that you can have as well.
I agree. I think that is also a room for a human plus the machine approach where we are complementing each other, where our intuitive will come into place at the same time, rely on the machine to do all the volume that we human could not possibly do.
Yeah, and I think one thing that has been identified is this area of zero shot or no shot learning, right? Which is essentially the idea that you can have limited inference. So you don't need the permutation of every action, reaction in order to fit a model to it, but you can try to take sort of transfer learning type methodologies, which is essentially one area of that. Another area is looking at babies and the way they learn and all that kind of stuff. So trying to understand what humans do well, which is that these cognitive shortcuts that we have about learning about systems, and then also inferring it. But I find personally that much of the human in the loop conversation is not about creating better accuracy necessarily, because I would argue that anything that you can describe to me verbally, I can encode it into a piece of code. And if that's the case, then I can replicate anything you can verbally describe to me. But this notion of trust, this notion of I want a human in the loop because I don't know how sensible the algorithm is. I don't know that it won't do something dumb because it doesn't have all these safeguards inbuilt, right? It's just trying to solve one problem. So the Elon Musk example of, we design an AI that makes batteries and then it kills all humanity and life on Earth in order to make more batteries, right? I mean, it's because it doesn't have any safeguards. It doesn't have any sort of greater contexts around what it's trying to do. So I find that conversation sometimes gets muddled in that human, I don't feel comfortable with the algorithm versus I think we can build a better algorithm with people in it.
Now, coming back to all this paper that you have written over the years, has any research topic in particular stayed with you longer than the others?
Oh, gee, look, if you're in data science or even if you're kind of curious about it, it's such a fast-moving, fascinating field that it's so hard to fall in love with something too long before it moves on to the next thing. I think from a data science perspective, I probably have kind of really enjoyed the flow of conversations, how we become better and better from NLP to CNN to the reinforcement learning elements of it. I really enjoyed ethical AI and biased AI and the research in there. And what it has brought me now into more is explainable AI. And my personal journey has been to start actually learning a lot more about cognitive systems in humans and the way the cognitive systems function in terms of a sequential series of logical arguments, or even some of the behavioral elements. And it's really kind of brought me to this question of how do we create compelling algorithms? So not only algorithms that explain something in a very kind of reasoned, logical way, even that can be a bit challenging, but also how to make those reasoned, logical things much more compelling. So the interchange between humanity and AI and that overlap, which you already referred to, where the two elements are living in symbiosis. and that what are the elements that need to be created, the bridges that need to be created from the AI world into humanity or into the human cognitive side. I'm not necessarily talking about Neuralink or physical implants, although I think that's also going to change the game, but I'm certainly talking about the way that the two parties communicate and reason and compromise and essentially how to do that, not in a manipulative way, but in a kind of a positive way, I think.
Let's talk a little bit deeper about that shortly, but I just want to come back to talk a bit about your background. So I know you just started a new consultancy called Qurious Analytics, but before you started this company, what has been your background that brought you to decide to do this, and also some of the things that you did in the past?
Sure. Look, yeah, my road has not been straight, but I think a lot of people's roads are winding for many reasons. So if you're at the beginning of your career and you're listening to it, don't worry if you don't know where you're going. It's even if you did, it doesn't matter. It will change.
I agree. So agree.
So I began life by doing actually psychology and philosophy, and I really enjoyed those kind of humanistic views of the world. And I went through my early 20s and got into finance. And I really enjoyed finance because there was something really clear and efficient about finance in terms of allocation of capital, efficient markets, cost effort kind of things. It wasn't idealistic, it was very applied. And so I did a finance degree here in Australia and did an honors degree, so did a bit more research, enjoyed the research, worked at university for a little bit, and then ended up in London doing a PhD at London School of Economics in finance. And so I did my PhD in finance. I went to NYU at the end, and I had some amazing experiences in the US academic world, pitching ideas and being part of that whole academic scene. I highly recommend, if anybody's thinking about doing a PhD, to go through that, to take those years, to sacrifice those income essentially, to go through that, because it really changes the way you think, go much more structured and much more kind of systematic. I came out of that and I wanted to become an academic, and so applied to lots of universities. And again, life rolls the dice and you kind of go left rather than right. And I ended up in BlackRock. And so BlackRock is a very large global asset manager, it's the biggest in the world, now some trillions.
Yeah, I heard about that one, yeah.
And amazing place, very, very sophisticated, very quantitative, and just amazing people in it. So I worked at BlackRock, and I worked at Fidelity, which is equally another large institutional, as a part of a quantitative research team. I then ran my own fund at Renaissance Capital. Sorry, not Renaissance Asset Management, big difference from asset managers. I then joined AXA Investment Managers, and later became the co-head of research there and chief strategist for AI, and kind of spent my time running around the world talking about application of AI in forecasting systems and different kinds of modeling for the financial world, essentially for various different asset classes and investment problems. In the meantime, I taught at university. I taught at Imperial College, master's in quantitative finance. I was a chief examiner for London School of Economics. So I kind of kept always a foot in the academic world. I was doing mentoring for fintechs and cybertechs. And then we relocated to Australia about 4 years ago. And I continued with my job for a while. And then I ended up switching to a local super fund and helping set up sort of the quantitative expertise there for about a year. At that point in time, I decided that I really needed to shift my career path. I wanted to get much more involved in the societal impact of technology and automation and AI. I think you get to an age in your life where you kind of think, okay, I've run one part of my career, and now I'm interested in exploring other areas. And so for me, that was looking at this. So I joined an AI startup, a bit more than a startup by that point. It was about 3 years in Australia, called Fathom, which is a great company looking at the impact of automation technologies on the workforce and industries around the world. We worked a lot with governments, with institutions, with large industry bodies around understanding and forecasting the level of employment impacts in different regions, whether that's emerging markets, which actually the impact is going to be much greater. Where the developed markets, we looked at a lot of different kinds of AI and automation technologies. And again, that kind of brought me into a really wonderful place where I could, use my quantitative and forecasting skills, but equally have a very social mission in mind in terms of what does it mean to be dislocated from automation impacts. So that company was sold to Pearson, and that was fantastic. That was a very successful acquisition, and that's going to continue to work under the kind of future of work type banner that Pearson's going to offer a lot of different things under, which is fantastic, more in education, reskilling, retraining kind of banner. And as for me, I've sort of gone back to my business that I had in the background called Qurious, and sort of looking at a number of different avenues going forward, including some in crypto as well, actually. And, the blockchains and all those kind of interesting areas that are just receiving a great deal of talent and attention, and really nice thinkers that are in that space as well. So look, again, not a direct straight line. I kind of did my corporate high-flying gig, traveled the world, did the Wall Street Journal, Bloomberg, CNBC, etc. Got into the AI space, which is fantastic, and I really enjoyed that. And I think one thing you have to kind of do frequently in your life is reinvent yourself. And so when a new thing's coming along, we know quantum computing coming along, we know that cyber technologies are big things as well. And so always being not afraid to learn about these and open a book and read a book on it, and just really kind of sink into some of these topics, I think has really helped me in my career.
I think it's so important to reinvent ourselves so that we can continue to keep ourselves relevant. And I find that is becoming more and more important, especially the world is changing so fast. One of the things that I am constantly reminding myself is, as much I to be honest, I still cannot grasp the idea about NFT. I mean, I can understand what it does and why it is, but I still cannot grasp the concept of paying a couple of $1,000s for a JPEG or GIF file, right? That is the thing that I cannot grasp. But at the same time, I gotta remind myself that in the 1990s, where I was young, I was like, internet is going to change the world. While at the same time, the older generation, like my father, would say, "What the hell is internet?" So that was like the way that I'm trying to think about NFT for now.
It's a fascinating topic. It's not that I'm an expert. I'm not going to offer you an expert's shadow over that. I don't think anybody is. But look, the way that I think about this stuff, maybe this helps a bit, is that a lot of this activity is happening underneath the umbrella of moving human physical activity into the digital sphere. So we're kind of trying to recreate our economies and our lifestyles in the digital sphere. And for some of these things, we've been very successful. So the call that we're having today, or email communication, and social media and so on. For some of them, we've not been, and money is now completely virtual and tapping, and there's very little physical currency, at least in developed markets. I think with this idea that one of the challenges of doing so is that you need to introduce scarcity. Because in economy, if anything to have a value and a price, you need to have a scarcity. You need a system that recognizes scarcity. Now, in a world where anything can be reproduced digitally, and storage space is not significant in terms of a cost barrier, you can reproduce. You can make a facsimile copy of your house, a digital house, and reproduce it 1 million times. Whereas in real life, it'd be much harder. So I can see the NFT, the idea or the beginnings of an idea of ownership and scarcity trying to be introduced. The irony here, of course, is that much of the population is striving for this change for Web3 and everything else, would like to have a more inclusive and less centralized financial system, payment system, digital economy, which would kind of take you almost away from a capitalist scarce resource. Few people own all of the assets, into everybody owns and everybody has equal access and opportunity and so on. So you need to kind of make these two things work in parallel. So for me, the NFT is it's a little bit like, remember that again in the 1990s, e-commerce was a really big thing. Everybody was like e-commerce this, and you had examples of mining companies renaming themselves. They used to be called, I don't know, bronze mining, and then they called themselves e-bronze mining, and the share price would shoot up. Yeah. Silly things like that, right? Just by association. Correct. Of a new technology being discovered. And even then, if you think about it, it wasn't until 20, even 30 years later now, let's say 20 years later, that the world is that technology forms a significant part of the share market, but not 100%, like 15%, 17% of the share market is the technology companies. And they form a significant part of our life day to day, but from an economic perspective, they are one cog in the wheel. And I feel like what you're going to find is that some of the protocols being developed for exchange and whatever will have great use cases, and then we'll have really poor use cases. And the great use cases will develop and create better industries and reinforce industries, and maybe decentralize some of those interesting industries as well. But the capitalist economy, the monster, the machine, will suck the innovation in, will utilize it to increase share price, to increase shareholder value, and whatever capability it has to. And then like the next innovation will be right around the corner.
Perhaps the NFT, the underlying concept can be further extended when we have that virtual world. I just want to go back when you were talking about the quantitative research for the works that you did in the corporate world. Just want to clarify, was it more of the researching, looking at the financial data and then writing the report, analysis, or is it more of the algorithm trading or high frequency trading, technical trading? What is the context of that in this tool?
Yeah, it's a great question. So the asset management industry is also known as the buy side. And so the buy side essentially are composed of investment products. Typically, these are mutual funds. So mutual funds, you can buy a piece of share in and your money is invested. Every mutual fund has a mandate, how it should invest the money. So an equity mutual fund will say, I'm going to buy US equities, for example. You know what you're buying a portfolio of US equities. And it's the job of the portfolio manager to choose which equities that you're going to buy. And in doing so, that portfolio manager can reach out for research to pull in to their process. The research is normally provided by the sell side, or typically in the past, and now maybe more boutique research firms. So sell side provides brokerage and research, and it goes into the portfolio manager's hands, who then makes decisions to what they should buy. With quantitative investment strategies, there is a portfolio manager, but their role is very different. So now, rather than having a person who chooses which stocks to buy, you have an algorithm that gives you a buy trade list, essentially, to buy or to sell. And in many cases, that algorithm will go off and trade to rebalance to that trade list as well in the market. So the portfolio manager manages the efficient trading. If the algorithms are great, and if it's high frequency, there's not much of a role for a portfolio manager except risk management. If it's different, then they might have more role. The research team in a quantitative research place is the job to develop the algorithms and to build the algorithms. So essentially, their intuition of the future, the methodologies, the data they use, goes into the models, and the models are driving what stocks you should buy, when you should buy them, how long you should hold them, etc. So my career was, I started with risk management. So I was at BlackRock. I was a part of a team called RQA, which is a phenomenal team that looks across many different strategies and to understand the risks that they are running and the commonality across those risks and make sure that they're consistent. But they're not managing money themselves. They're not involved in stock picking. They're just involved in helping the business manage. So that's a great introduction to understanding all these different animals in the asset management kingdom, to seeing what each of them do and why, from hedge funds to debt funds, equity funds, private equity, and so on, fund of funds, etc. My next role and most of my career from Fidelity onwards was in the development of the algorithms that made the investment decisions. Most of these algorithms would be day-to-day trading. They would not be intraday algorithms. They would not be high frequency. And most of these algorithms in my career looked for fundamental data to make those investment decisions. And so there's, I'll quickly drop a line here. So I had this nice project I did called Qurious Quant. It's a 20-part podcast series. And basically in it, I just talked to a bunch of quants like myself who do these different kinds of strategies. And you can see the range. The range goes from high frequency, data-led, intraday, microsecond transactions, all the way to the other end, which is much more asset allocations and much more strategic, slow long-term forecasts. Where's the US economy going to be in 10 years and so on. So the range of forecasting problems varies, and then the portfolio construction, the risk management, everything else that goes on top of that in order to create the product that is a mutual fund that is then kind of delivered to the client.
So from someone like you who has got a quant background and who has been playing with data and analytics for the last 20 or 30 years.
How old am I, Jason?
Now, 20 or 30 years not necessarily apply to you.
In my mind, yeah.
For the industry itself. And that quant application is similarly done in the world of the insurance and the bank. And it was never known as data science, or it was never known as AI. Do you think with the new terminology like data science and AI being introduced over the last 10 years has accelerated the adoption of all these works that the industry has been doing over the last 20 or 30 years at a much faster pace, and also attract more attention?
So it's a great question, and that's a long answer to it. I'm going to try and summarize everything in my mind about it.
Or maybe if we take a step back, the way that I see it is that all this quant work, all the actuary works, to some extent is no different to data science or AI. Perhaps the newer technique, because of the technology and the computing capacity, allow us to do some of the things that obviously we couldn't do 20 or 30 years ago. But at a high level, I see them the same. But I equally think that because of the newer terminology being introduced, and that has accelerated the pace of this adoption, or at least the attention.
Okay. So it's let me try and tackle this. So quant as a field of applied finance, or data science if you want, has incredible roots in academia, and in very high pedigree academia. So the Yales, the Harvards, the Chicagos are filled with people who run data, forecast quantitative models, and all of the major quant funds that were developed on the back of this academic work in the late 1990s came to the private sector with a view from the physics background, from chaos theory, from all these wonderfully highly technical areas of academia, that they could forecast the markets. So that was really their primary objectives. We can forecast the market to make money. And so the use case was very clear, a very specific use case, and the flood of talent that flowed into the markets from that very specific use case created hedge funds, created all these different financial products, including the index product, which was originally developed by BGI, actually developed probably before BGI, but BGI was probably one of the major proponents of that. And so there were these titans of industry that came from really smart professors who moved into the private sector. So that shaped the kinds of problems that were being tackled by this industry. When it actually wasn't the methodology, it was the advent of Amazon, and it was the advent of Google and the success of these major technology companies that used data at scale and were able to create just incredible business outcomes, scalable business outcomes, that put first the financial markets on alert that there's more here than what we should be doing. So what were we doing? And data science, I remember being at a conference in London with a room full of quants, like imagine 200 quants. And I was on a panel with 4 others. And we're talking about, at the time, it was a Macquarie head of research, it was BNP head of research, all quants, and myself. And we're talking about the application of data science and machine learning models in finance. And we're looking at each other going, it's not going to work because there's limited data, the things are moving too fast, forecasting is very poor, noise is too much. It's not the right methodology for these kinds of problems. And we all agreed, and the room agreed. And once we left the conference, we all kind of looked at each other over beer at a local pub and went, but isn't this how the dinosaurs would have thought about the humans? Like, these people are small, they're insignificant. And it's then interesting to see the next conference, was not about if you should use AI or big data as it was known back then, but, and by the way, AI is never AI. AI is a holding term for all things related to data science. It became how to. And so what happened in financial services is that the adoption of data science methodologies into the investment process was driven by competitive pressures. You needed to show something different. You needed to show innovation. You needed to show change. So you adopted it, even though you weren't sure if it worked or not for you. You weren't really sure if it was going to change your life or not. On the other hand, the other parts of the banks, insurance companies, and so on went, look, we've got these massive operational teams, customer service, customer support, claims handling, financial transactions. A lot of our cost base lives in these less intelligent functions. They're not analytical, they're not forecasting, they're not doing any of those things. They're just repeating the same task again. Maybe we can use data science for what I would term as intelligent automation. And so like any other industry, these financial services went, let's go and create a data science team to automate things. And still to this day, I can tell you that a lot of the data science deployed in financial services are not about forecasting or getting a better solution to a problem, but they're rather about automating and creating cost efficiencies for the middle and back office of these operational settings. So I think what one should be careful is that data science, obviously, has a lot of hype from the likes of Google, who use it in amazing ways to create new things that have never been created before. I think in a lot of other industries, it's not well understood. The value is not well described, but where the value is well described is through this idea of let's go and automate a bunch of things that we do repeatedly. And so I feel like the third thing, which was a pure product of data science culture and community, was one of sharing. What was very unique about this movement called data science is that people were sharing their code. They were making it open source. They were giving it away. Quant never did that. You went to the conference, you took notes, you showed nobody because you were competing. It was the same marketplace, right? You were trying to make alpha. You were trying to outcompete the other people. But when data science conferences, they were like, yeah, here's my code, GitHub, library, bang, boom. Anybody can have it. You can improve it. So the progression, the innovation was much faster. Then you had, the cloud systems becoming open. So anybody with $5 in their pocket could get a supercomputer hired for a half a day. And suddenly access was opened, sharing was opened. And the whole culture of this meant that innovation, progress, and learning and community-based education was rampant. And because of that, you had a much more, let's call it, much more supply of I would call the second tier data scientists. So the first tier being like, I went to university, I did computer science, I'm a data scientist. And the second hobby data scientists are those ones that said, I learned it. I picked up some websites, I learned some Python, I can run some APIs. Great. And so suddenly you had a lot more supply of these people as well. And they could make a lot more difference. So again, it's a great question because in some ways data science came on the footsteps of quant, but in many ways the culture of the organization, quant being secretive and academic more, and data science being helpful and much more in the software space, and the user knows everything, and it's the user preferences, and it's the product research, and it's all that kind of stuff, means that it's much more ready to move into different elements of the business.
I also remember that quant was incredible difficult to get in. Not only you need at least a PhD, but some guys even had 2 PhD just to get a quant job. Whereas data science was entirely different story. It's more of a software perspective, and you got a degree, or maybe, as you say, as long as you access the internet, learn to write some of those code, then is incredibly accessible. Now, bringing those two subjects together, how do you think the AI adoption or the data science adoption is progressing specifically in the investment fund management or the superannuation?
So I'll say something controversial because I'm allowed to, because why not?
Go for it.
Not well, I think. But then you kind of expect that response from someone like me, but not well. So this industry has been but increasingly put under pressure by lower fees. So there's a great incentive to automate, to restructure your business. At the same time, the roots and foundations of asset management is still something extremely human. It's the basic idea that I have money and I'm going to hand the money to you, Jason, and you're going to manage it for me. And that feeling of trust and the emotion of trust that I put into you is based upon the idea that it's very hard to forecast the future, and the service you're providing me by investing my money is highly uncertain. So because the service you're providing me is highly uncertain, I need to trust you as a human being. I need to have that emotion that I trust you. And so therefore, could I have the same feeling and emotion if I was to give this to an algorithm? So surely if the algorithm is always winning, it's easy, right? It's not hard to trust your phone, your iPhone, your Google, whatever, because every time you talk to it, it talks back and it understands you. So it's functional, it's doing what you say. How would you trust something if it only worked 50% of the time? So I think it's a very it's a very interesting problem where in the space of asset management, which is forecasting the future, we'll often continue to have the human element of it. So if you turn on CNBC or Bloomberg or any of these things today, you will see people talking to people analyzing, conversing. You will rarely ever see a quant or a data scientist or anybody else going, yeah, and look, we've got this model and the model is telling us this. And the model is really good at this. And look at the model. It's a really interesting model. You don't have that conversation. You have the conversation with people, throwing their hands around. Their earnings are terrible. Their earnings are bad. It feels like you're sitting on a campfire, roasting marshmallows, having a great time. And so it's a very human activity. And so you kind of go, look, at the heart of this industry lives a very human relationship with each other, and a very human trust, and to some degree, a bit of hero worshipping, right? Fund managers and idealisms and all that kind of stuff. On the periphery sits all the things that you want to just give away, like operational middle back office kind of elements. The only way that we can move this industry into more adoption is if we are more efficient at combining the front end of the business, which is the charismatic, smiling person who tells you that you should trust them, and the back end of the business, which has to be a lot more systematic, structured, data-led decision-making. The problem is at the moment, we've got that charismatic person thinking they can also make very structured, systematic investment decisions. And I would say that that's yet to be proven in any kind of meaningful way.
Would you say that's the core reason why RoboAdvice is not taking off entirely?
So advisory business is a very interesting one. So there's a number of research pieces that have been done on this. So
sorry, just to clarify, I was referring to the RoboAdvice. If I get the terminology.
Oh, RoboAdvice. Yes.
Oh, Robo. Sorry.
Yes. No. Exactly right. So I think you said Rebel Advisor. I would like that. I like that. Adventurous advice. I want the Rebel Advisor in my life. I don't want the RoboAdvice. Yeah. So you're right. Very early on, RoboAdvice in the early 2010s came along and said, look, we can allocate your portfolio more efficiently for you, right? Most allocations are 60-40, 60% equity, 40% fixed income. We can just do that for you. And when you speak to these companies, especially early on, and you said, how are you forecasting the returns to equities and bonds and all these things in order to make that assessment that 60-40 is the efficient number? And they look at you and say, we don't think it's a forecasting problem. We think it's a risk preference problem. We have high risk, medium risk, low risk, and then this is some numbers next to that. And so you're like, okay, so you're completely forgetting about forecasting the future. You're completely forgetting about the horizon of those forecasts being really important and so on. So it's not at its core useful in the content. So you're not getting a more informed piece of advice than you would be from a back of an envelope. However, the value proposition, I think, for those companies was the features, the ease of use, the UX, the UI. So in typical SaaS format, this is the software format, they went, well, the core problem is people can sort that out, but we're just going to give them a better experience. And therefore, they're going to come to us because otherwise they have to go to an advisor, they have to talk to them, and et cetera, et cetera. And as you say, there was a lot of hype around good RoboAdvice, but in the end, it didn't take off because, for the most part, people wanted a delegated decision making here. They didn't want to sit there and play with the allocation of money. They wanted an expert, delegated expert, to do that for them. And in order to do that, you needed to have trust, and you need to feel like an emotional trust. So the fascinating thing, and this is for full disclosure, I'm the non-exec director of a company called Klein, which owns a company called Madison, who does financial advisory. So we've done a bit of work on investigating the drivers for people to derive value from a financial advice. So if you're an engineer, you would say, it's for my money. It's just to invest my money. Just do it more efficiently and I'll derive value. It's fine. But when you look at the data and statistics, people derive value from financial advice from feeling like they're in control, or feeling like their money is going well. Especially money is such an emotional topic. We all have feelings about money. We either feel anxious because we don't have enough, or we feel confident, or we feel it's a way to measure us in the social sphere. There's lots of different. Money is not a objective idea, even though mathematically it's a number. It has a lot of emotions bundled around it. So when you have someone talking to you about your childhood memories of your mom, or when you have someone talking to you about your money, equally, there's a lot of emotional elements. And so a lot of the financial advisors will tell you that half the time they're acting like psychologists when they're talking to clients. So the challenge of a software company or a data company is, how do I invoke all these emotions in people while making them feel like, they're in control and it's a good thing and whatever, and still do it scalably. And so far, I think that way of doing things, this kind of nudge marketing, has not been successful.
That's great. Thanks for sharing that. I'm curious to know, though, what do you think are the other main reason for the lack of adoption of data science or AI in the investment fund management or superannuation?
So, one of the bigger reasons, I think, is the lack of adoption. There's two reasons, right? Well, one is mundane and one is interesting, in my mind anyway. The more mundane reason is data and systems. So everybody's struggling with complexity in data and systems. Many companies have built data lakes. Many companies are trying to adopt and supply dashboards, analytics to the business through those data lakes. And some businesses are still struggling in doing that correctly, efficiently. Data, don't forget, in the financial services, heavily regulated industry, has to be correct, has to be right, has to be double checked. These banks and these organizations often have a myriad of different systems that don't talk to each other, that efficiently push data around. So before they can even get to modeling or forecasting, they need to have that sorted. And so that's often a barrier. I think the number two thing, which is a more subtle but more interesting part, is this idea of how you make decisions. So most organizations, including many, I'm sure your listeners, will sit down in a meeting, will review the past meeting notes, will come up with a few facts or a few observations, and they'll make a decision that they think they should go one way or the other. If you ask them, did you make that decision based on weight of probability? They would say, well, nothing as formal as that. And you say, well, how did you make decisions? Well, it's what the boss said. It's what we did last time. It felt like the right thing to do. And they'll really struggle to put their finger on the reasons or the drivers of a certain decision. Or they'll become fixated on a single decision. Oh, but this happened last week and I just don't want it to happen again. So we anchor ourselves and we put ourselves into separate things. Now, along comes data science, along comes AI, and goes, look, we've looked at 10 years of cases. We looked at all this data and we figured out what the optimal way for you to make decisions based on these 200 different variables. And a user, typically an asset manager or a banker or whatever, will look at that and say, well, but how do you know it's going to be right this time? Because for them, what they're trying to do is not work out the system and all the things that could drive the decision. They're trying to work out the exception. They're looking for the change, or they're looking for the difference in what they would normally think of. So oftentimes you have just a sort of almost like an existentialism. It's a philosophically different approach. A typical portfolio manager, for example, will look for something different about the company. They'll look for something that's unknown. They'll look for almost like a gold digger. They'll be out there scrunging, looking for pieces of gold, shifting around the water, etc. Because they feel like if they can find there's something, they can buy their stock, and then everybody else realizes there's something and the price shoots up and they make money. Whereas a quant or a data scientist will go, right, the drivers of stock price are A, B, C, and D, and we think these set of stocks are good based upon these 4 factors. But the drivers of those are all public pieces of information. So what the data science team is promising is that they can use publicly available information in more intelligent ways to make better decisions. Whereas what a professional will say in asset management is, how do I find out a piece of information that nobody knows? And then I just use it. So they care less about how they use the data, or kind of in a systematic structure in whatever way, and they care more about finding unique data. That's part of the reason why alternative data has become very popular, probably even more so than AI. So alternative data is a branch of data that's coming into, or has come into, asset management. So traditional data is financial data like earnings, revenues, stock prices. Alternative data is, I don't know, flight frequencies and how many boats and ships are moving between ports and so on. So that's become a lot more popular than the AI side, because it's easier to show that you can derive value from it, because, hey, you know something nobody else does. So I think that the data science, in order for it to be adopted greater in these worlds, you have to really show that the way to use information means that you can pick up a lot more alpha and returns than just knowing more stuff than the person next to you.
The access to the data and also organization of the data is always a problematic in a lot of places, whether you are small, mid-size, or even to some extent is the same problem that the enterprise are facing. I think there are 2 problems with it. Number one is people are making it way too complicated by following the framework too rigid. I really have to use this methodology, that methodology to be able to build the data warehouse, etc. But then they forgot about the end user who use it have to join another 200 table just to get the data. I'm curious to know, however, is that especially for the mid-size of the self-managed, the investment fund or superannuation, they are going to struggle and face this problem anyway. Maybe that would they be interested to subscribe to a service who literally just provide all this data to them, and they can still have their portfolio manager or investment manager to do all the construction of the portfolio, but at least they don't have to worry about the data, and that data could consist of all the financial data that is in the market. That data could also consist of the alternative data. What that data doesn't have is the customer data that each of those companies would have, but they can combine them internally anyway. Do you think that is that already been done?
Yeah, absolutely. So I mean, the financial service industry is pretty expert users of the data sets as it pertains to traditional data sets. So you'll have the likes of, and there's many more companies than I can mention here. So you'll have FactSet, you'll have Bloomberg, you'll have, to some degree, Aladdin, you'll have Charles River, you'll have a bunch of other analytics companies who will take some combination of your portfolio data, which is just yours, and publicly available data like prices and whatever, and give you one interface to look at that. So you can have a look at your portfolio, your exposures in your portfolio, risks, the fundamental data. Maybe you can do some fundamental research as well. Alternative data and S&P Capital as well, and others. And there's market, S&P Capital. I could just go on, but the idea is that each of these vendors is now competing to acquire more data sets to be able to provide more insights to their clients. But because they're SaaS software data companies, what they do very well is give you access to companies, and they hoover up all these alternative data sets and they say, here you are. What they don't really do very well at this point is to show you why you should care. So if I showed you the air traffic airline data, what does it actually help me forecast? And why? So they have to be very careful not to give you financial advice. So they can't give you forecasting models. And so therefore, what they can do is to make data available to you and put out white papers that showcase potential use cases for that data, but without actually being too prescriptive. And that's a big challenge for these kind of companies. I think that the other weakness of not just asset management, but insurance and banks and so on, is a little bit like the philosophy that you just outlined, which is, do you do this in bite size or do you do this in aggregate form? If you do an aggregate, you give it to a centralized team whose job it is to create the data lake for everybody. And that's very hard to do because everybody has their own needs, desires, technical capabilities, and so on. And so it's often an impossible task that runs into tens, if not hundreds of millions of dollars in budget, runs over time, takes too long, is too complicated at the end of it. On the other hand, you can have bite-sized or fragmented data sets and data structures and teams who are using their own data sets to create a business and either live or die based upon that. There's organizations that do that. It's harder to govern from a central perspective, harder to manage, but it means that you can experiment much quicker. You can bring in a data set, you can look at it, explore it, apply it, not apply it, move on, move on, move on. And there's probably some combination of the two things that you feel good about. Like, some of my items could be done to data lake, and a lot of the other items I need to experiment with. But unless you're ready to experiment with the data, especially with alternative data, you're going to be far, far behind the rest of the pack. And so I think what at the moment is a big barrier to the bigger organizations being more nimble is that they need to integrate these big data sets and find out why they should pay all the money for them quicker. And then they need to pull them into these big data structures. When in fact, I think most of the time, what they really want to do is just get a data set, run it through a system, have a look at it, get a sense of it, have a conversation. Is this worth 50,000? Is this worth 100,000 to us? Is this worth $200,000 for us? Yes, no, maybe. What can we do with it? What can we not do with it? Okay, let's buy it. If we buy it, can we start using it next week? Not, okay, now there's the integration process. Now there's an acquisition process. Now there's a whatever. In 18 months, we'll have it up and running maybe for you because we have a long queue of things we need to develop.
Exactly. Now, earlier we spoke about the human trust when it comes to AI. And I think this is probably where the explainable AI coming into the picture. My question for you is, how does explainable AI play a part in the investment fund management industry or superannuation industry?
So explainable AI is not yet a concept that's really well developed. So there's quantitative funds whose job it is to explain their models. And some of them do a good job, some of them don't do a very good job. And in fact, it's very hard to find the skill set of quant that is good at explaining things. Because by definition, your job is to be technically really capable. And in some ways, you need to then pull yourself away from that and go back to that conversation with your grandma to say, how do you describe to your grandma at the dinner table what you do? And if you can manage that, then you can explainable AI is yours, right? It's great. You've done it. And so I find that that's really one of the big challenges that this industry doesn't do very well at. And the other side, of course, is that you can also reduce and explain something that is highly complex and difficult into a couple of ideas and actually give a sense of explainability to somebody, but in fact, actually do them a disservice because now they believe that it's just about those two things and it's not, it's about 40 things. And so you've made them feel good, but actually they haven't really understood anything. All you've done is just make them feel good. And so I think it's, with the asset management and systems, people are very smart in this industry. They have often very good degrees, very high academic power, very complex thinkers, and all sides. And so I feel like most people are able to understand that the markets are complex, forecasting is difficult, their financial data is cumbersome and so on. But I feel like we in financial services, maybe with the exception of banks and insurance companies who have to deal with individuals and price insurance contracts or financial contracts based on individual characteristics. In asset management, you face up against the market, not people. So a lot of the models that about explainable AI are really focused about why you make decisions about people. Why does a person get a loan? Why does a person get access to a scholarship? Why should a person be on criminal record watch? And so they need to be explained because there's a social weight, there's a social consequence to your decisions that you've made, especially if it's a denial of service or denial of activity. With financial services or with asset management, you're making decisions about the market and investing, and your outcome of that decision is immediately in your returns, in your P&L. So it's one of the rare cases where you can create a model, put it into practice, and you immediately get a feedback, whether you're right or wrong, immediately. Whereas many other cases, you create a model, you put it into service, and it's doing stuff. Like some people got loans, some people didn't get loans. I don't know. We'll see kind of over some period of time whether they repay their loans and how they repay. And so the idea, the attribution, the feedback isn't as immediate. So I would say the explainability has a social weight and social consequence for individual forecasts, which is insurance banking to some extent. I think for asset management, explainability is proxied for by the market that tells you whether you've got your returns or not.
Would you say that is the biggest challenge, or what would, if not, what would be other biggest challenge then in implementing this explainable AI into the asset management?
I think the problem is, okay, so the implementation of explainable AI is like any industry, I think, in the sense that you have to have people who have a very systematic reductionist way of thinking about the world to understand. In a statistical system, you are reasoning through deduction. You're saying, I have data, I am going to reduce the dimensions of that data. I'm going to find a number of different factors, and I'm going to use those to explain the data. And that type of reductionism views a certain engineering mindset, Lego builders, engineers, etc. Very easy. Then you have other people who reason through induction, example cases. I have my brother Joey. My brother Joey dropped a hammer on his foot. I'm never going to buy a hammer because Joey. How do I reason with that person from a deductionist? That I can show that 99% of people didn't drop the hammer, but Joey did. And so this idea of your reasoning system, of what context, how do you come to decisions under uncertainty when there is a risk of an outcome, when there's a financial risk or a social risk and so on, and whether you come to that decision in a rational way or not. So gamblers, the professional gamblers, make decisions based on weighted probability. They have a structure, they have a system. Everybody else doesn't. We make decisions based on, charms or luckiness or how you're feeling or whether you won last week or whatever. So we take bets on certainty based on all these different characteristics. So I feel like this industry has become a lot more institutionalized in the last 20, 30 years, which means that people have become much more structured in their thinking. Whereas 30 years ago, the people in the industry were much more professional gamblers, essentially, think about Wall Street and those kinds of things. They become a lot more engineering reductionist. So I feel like the foundations are there. I feel like there's still a generation of people from a scientific background who will come into this industry. But I often find it incredible that for an industry that's so high powered in terms of the academic requirements to get in, the practice of the business is still so unscientific. So if you ask people, why did you make the decision to buy this security? They'll give you 2 reasons, 3 reasons. Then you go to the next security, they'll give you 2 different reasons. You go to the next, they're going to give you 2, 3 different reasons. Then you ask them, why didn't you buy this other security that you could have bought? Because it's a relative return game. And they'll say, I didn't think of that. And so even structures like that going, what is your system? What is your structure of those factors that you choose from, of how you balance them, how you offset them against other things, the things that you didn't do? The reasoning systems are absent in many cases. And there's a sense of, I'll just give it a shot. Let's just see what happens. Oh, it didn't work out. And then on the other hand, you've got provable examples of people where they've been wrong. And so the stock has gone down, for example, and they're holding it. And they're like, I don't want to sell it because then I'll realize my losses. Well, you've realized your losses. It's already down. And so then you start to see everything from technical analysis, which is commonly used in crypto and in stock markets as well. And there is no statistical foundations for statistical analysis. You've never seen it proved systematically. I mean, I've tested like dozens and dozens over the years, right? It's unprovable. And yet it's a very frequent thing. And there's a mountain of biases about looking at a graphic and going, it's a bit high, it's a bit low. Oh, I think it's going to go up, it's going to go down, etc. And so it's sort of still a very unscientific area. And I feel like in order for it to improve and embrace things like AI and ultimately explainable AI, it needs to have a desire to be more systematic and be more structured, rather than a bit more kind of, let's say, on the fly.
I think that is probably where the human element coming into play, that ability to understand human and also expect human to behave in certain way is something that seems to me is never possible after living in the world for the last 40 years. I suspect that is going to change. And at the same time, to put that in the context of analytic or data, is it just simply cannot quantify the human action.
Look, there's two different things here. One is, social media has shown us that we are very influenceable. The data can be used to quantify and forecast our desires and our preferences. That we can, and these are not very intelligent algorithms, by the way. This will be considered as a first generation social media algorithms, because they essentially just reflect more of the same. If you looked for videos about kickboxing, you'll see more videos of kickboxing. Fine. It won't measure what time of the day or what time of the week, or whether you actually did it. Like the same with Amazon. If you bought some nappies, it will show you nappies now forever. And you'll be like, okay, I bought my nappies already. And so I think these are just the first things. But this idea that most of us are actually quite similar when it comes to being triggered in certain emotional responses.
Yep.
Tells me that over time, algorithms with more data, with more processing power, with quantum computing, etc., will be able to much more clearly evoke emotions in humans. And the way that they'll invoke emotions may not be in a very linear way, maybe with music, with sounds, with AR, VR, with various other types of learned behaviors. And over time, I think invariably, because we are not evolving genetically, but the algorithms are, there is a sequence of stimuli, keystrokes, etc., that will unlock us. If you ever read the book Snow Crash, it's a wonderful early sci-fi book, cyberpunky early stuff. And in it basically says that language is but a code of the brain. And if you can hack language, you can hack the brain essentially. And so there's this kind of storyline around that. But there's a lot of truth in the sense that the brain and our responses are absolutely hackable. Data and systems will get better and better at finding triggers and being more contextual and more specific around that. That doesn't mean that we can solve problems better. So that doesn't mean that we have a better asset management industry, but it does mean that we'll have an incredible marketing that will make us really like that asset management machine, even if it does not doing good things. So my hope is that we actually get better at asset management, and that's the reason why it's become successful. But I think as an industry, and this is now really pushing the boat out, I don't think we've got much better at asset management over the last decade or two. I think what we have got really much better at is distribution, marketing, scale, the use of scale. So it's an industry that has moved to scale usage more than it's become an expert.
Can you explain a little bit or elaborate a little bit further about the scale? I think I can understand about the distribution. Robinhood, the company in the US, I think is a classic example of like how they do the distribution well, where you just get more people to be able to be part of that investment, and whether it's right or wrong, there's a story for different day. But what do you mean by scale?
The question is about scale. And the answer is, if you look at the top asset managers in terms of the concentration, Vanguard, BlackRock, etc., what they've been able to do is to create incredibly complex multi-tiered businesses that are able to house a huge amounts of different types of investment strategies for clients. and manage these effectively and at low fees. So they've been able to compete on fees straight down, have operational excellence, risk management excellence, and as a result, an industry that has a homogeneous product will end up competing on scale. So either you evolve your product and you create incredible value in that evolution, and that's how you compete against your competitors, or you basically say, you know what, we can't really create a better product or meaningfully better product, so we can't do a 10x. So what we're going to do is we're going to go to scale and we're going to push down to price. And that's what you've got. You've got a U-shape type development in asset management. You've got the mega guys, you've got the tiny guys, etc.
Right. That is the economy of scale. Now, to wrap this up, can you give us some case study where AI has been critical to success in the asset management sector?
It's a case study involving AI in financial services. So I think there's a number of different areas. I mean, the ones that have been well documented are probably things like fraud detection from banks or indeed insurance companies, things like, basically money transfers and patterns and movements of money and those kinds of things. I think in asset management, I would say that there's been a number of really interesting applications of alternative data in the world of carbon and ESG investing. So the big story for a while in asset management has been to move to a decarbonized portfolio. And how do people move to that end? To do this, you have to find companies and investment opportunities with low carbon. To do this, you have to have better data. The other area I think that's been really interesting, and you've seen some movement here, is being around the application of natural language processing, specifically to news items. So in financial markets, it's all about the future. Everyone's constantly thinking about what's next. And so the funnel is huge in terms of what's happening. You get information about corporate earnings, you get information about political tensions in China, you get information about anything, any topic that you'd ever want, constantly. And so often this industry is overwhelmed with data, and understanding how to summarize or even understand that is very important. So people have been looking at natural language processing applications for the past decade, I would say. We were starting with very simple kind of bag of words to vec kind of applications where they're looking for sentiment or keyword searches. So for example, there'll be algorithms out there looking for disaster keyword searches. And every time they detect a news article talking about a disaster that's located, for example, in a refinery, they will go and buy oil, because it knows that if the refinery has a problem, then oil supply is restricted, so oil price will go up. And so there's all these kinds of circumstance and situational type algorithms. And indeed, probably the ones that are even more powerful are the ones that are trying to process millions and millions and millions of articles a day, and trying to use, and just to go back to the previous point, trying to use human intuition as a way of replicating human intuition to summarize and condense the NLP. So today, for example, you'll have multiple vendors that will sell you either in raw or in process form the results of processing millions of articles a day around sentiment, individual company sentiment, corporate earnings, political, geopolitical risks, all the way to private sector commodities and so on. So I think the challenge again is the fact that NLP, or from a software perspective, they will do really well at condensing this information. I think there's a different kind of challenge which talks about how to place the trading bets. And I think the final one I'd mention is that obviously high frequency trading was a big topic a number of years ago. They've gone all very quiet. So high frequency trading operates under the surface. They don't really advertise what they're doing and how they're doing it. So it's hard to know if they're doing well or so on. But I feel like that's kind of an area where a lot of technology and a lot of the, especially reinforcement learning algorithms, will have a lot to say, including trading. So when you think about market making, and you're trying to understand how you should price certain securities, and you're playing a bit of a mini game of liquidity discovery, then systems like reinforcement learning certainly were very popular a number of years ago to see if that can be done that way. So again, a typical hedge fund will use any combination of all those things to derive some value for their clients, from market making intelligently all the way to being first respondent to news in a high frequency kind of way, using natural language processing to understand the topic and the prevalence of that topic, in terms of driving prices and outcomes and so on. So any number of those applications.
Thanks for that. Now to close off this podcast interview, these are my final two questions that is not related to the AI or data and analytics. The first one is, if you were starting out your career today, what area would you focus on and why?
So there's no doubt that today software engineering, machine learning, people have a wonderful advantage in the future. Anybody that can speak to analytics and devise things is in a really good position. Even if no code or low code systems take off, I think they'll still be in a good position going forward. To me, this is a little bit, again, controversial, but we like controversy. It's the weaponization of AI is the next big frontier. So we've had the first tier, which is almost like this organic growth of a community of people sharing code and creating problem solving, etc. Some of these problems are really good for strategy creation, deployment, development. Some of them are really good for drone control and robotics control, autonomous weapons, and so on. There's been a lot of conversations about autonomous weapons, how you define them, how you think about them, whether countries should do them or not. Whatever your position on that may be from an ethical perspective, I think the bottom line is that many of these systems outperform the current human systems. And so therefore, from a, I suppose, a dominance, kind of nations kind of perspective, if you do not adopt a system that can outperform yours, your competitor, your nation does, you will be outcompeted. And that may not be about a full-scale war. That can be lots of different cybersecurity, for example, and so on. And so I think cybersecurity and the weaponization of AI and information and data is a huge area that will see a lot more attention. So that's probably the safe play, but slightly more somber play. I think the other play for me is VR and AR. So virtual reality is fascinating what it can do. I think it will become, Ready Player One like, if not slightly more adult. And I can see the development of those devices, really the version 1's what we have today, but version 3, 4, 5's being just super realistic and super enjoyable.
I think the VR thing, sorry, not the VR, the AR, the augmented reality, I can see how it could work really well, especially blending in that whole digital world in the physical world. I'm really look forward to see that one. My final question is something you would tell yourself at your 20?
Geez, what would I tell myself if I was 20? Go write your name. What was that saying from Red Hot Chili Peppers? Go write your message in the pavement.
What does that mean?
Well, I don't know if you ever had this thing where if you ever lived in a neighborhood where they were laying concrete, and
yes,
the concrete was soft, and so people would write their name in or something like this.
Yes.
And so there's this idea that when you're in your 20s, your job, I think, is to go as far as you possibly can. So to challenge yourself to go as far as possibly can. So you really have to realize what are the edges of your capabilities. And in this particular case, if you're 20 or 25 and you're listening to this and you're thinking about, I'm in a job or I'm a circumstance where I'm kind of okay, I'm a bit comfortable, I'm not sure I've really gone, then you're not really doing your job. What you need to do is to do something at the highest possible level that you can find. You need to seek mastery. And to do that, you need to find people that are masters of that thing, craft or company perhaps, and you need to get into those circles. That might mean changing continents and countries. That might mean doing lots of crazy things, to be living, sleeping on sofas and whatever else. But it's really a wonderful time to push yourself to the edge of your capabilities and to know what the edge is and how far you can go. I think that will serve you really well later on. And maybe that's not very far. Maybe it's kind of reasonably far. Maybe it's very far. But it's really is the years to do that, because then I think as you get older, more and more people look to you to help them or to guide them. And in order for you to be useful in that circumstance. You need to have experienced, and you need to have pushed, you need to have seen. So yeah, go write your message in the pavement.
I so agree, especially also in the younger years, you don't have so much of the commitment in various forms, like whether it's a financial commitment, family commitment, etc., etc. Is really the time to push the boundaries.
100%, and be a little bit reckless. So again, this idea that if you aim for the stars, you land on the moon.
Mm.
So if you're interested in data science, for example, today write down the top 5 academics that you really like, or the top 10, or write down the top 10 Twitter people that you like, or just build me a list, and then find out where each one lives in terms of where they work. So they work at university, they work in a company. How do I go work with them, for them? What do I have to do? If you're an academically minded person, find a professor, write them an email saying, I read these 3 papers, I really like them. Can I work with you? Can I be a research student? Can I go further, like that? If they work for a company, similarly, write them. Do you have any internships? Is there anything I can do? I've read your 3 papers. I love it. I want to work in this field. I want to learn. Most people in that position will try to make time for you if they can. But if you've written a list of 10, you'll find a couple of them at least that will say something positive to you. So I think you really have to have that target, right? That kind of almost like in the ancient Greek world, that Socratean point of view, where you go and learn at the feet of the masters, kind of the great thinkers of your time, and try and develop yourself.
Yeah, and become their apprentice. And believe it or not, in the world that we live in, is making it so much easier and to access those people. And believe it or not, equally is all those people are actually quite accessible.
Absolutely. I think we all have LinkedIn profiles, and we all get messages. And no, but seriously, I get loads of different requests to follow is easy, but also to connect with, from people from India, from Sri Lanka, from Pakistan, researchers, interested academics, all these different kinds of people who are just pushing forward and trying to understand the world. And absolutely, I accept all of them, because it's, as a human intuition to help people and to move them forward, is absolutely part of our psyche. Yeah.
100%. Thank you so much, Michael, for sharing all this knowledge in the Analytics Show podcast. So excited. Thank you for that.
Thanks so much, Jason, for having me.